Dividend growth investors, bonjour, Makiru here, and welcome to day number 3 of this How to Invest a Lump Sum Amount of Money in 2024 series. Today I'm sharing with you 4 of my favorite Canadian picks for the year, mostly with one thing in mind: is I want something that is secure. I want something that is a business that has proven itself in the past, that is a dividend grower as well, and that will not crash and burn my portfolio. Because the most important thing that you're thinking of when you are about to invest a large amount of money is, I don't want to get caught up in a market crash. So at least if you do that, well, at least you're going to buy some quality investment, right? Towards the end of this series, we will talk on the timing and the structure to how you can build your portfolio. That is going to be after today and tomorrow's video. So the part number 5 and number 6 will be about portfolio building and the timing. So make sure that you like this video, subscribe to the channel, and put the notification on to make sure you don't miss those. So today, let's get started with the number 1 on my portfolio list would be Tellis. Tellis, why? Because first, it's a great balance between growth and income, and also because the stock price has been getting beaten up and beaten up and beaten up since 2022. So now it is trading at an attractive valuation. The company continues to grow their dividend, but what you can see there, and here's the problem: revenue keeps increasing, dividend keeps increasing, but what is going on with the earnings, right? So take a look at what really happened in the business model. So as you can see in the business model, we do have a large part of the business that is all about wireless and wireline services. And this is the core business for Tellis. That part is doing well. The problem comes from healthcare, agriculture, and also Tellis International. So the play they decided to make with Tellis over the years for the diversification is to focus on technology to increase growth vectors and trying to find a way to get outside of the wireless and the wireline business. It is very promising, but right now it is not skyrocketing because we are in a down cycle. A lot of companies prefer to keep their money inside their bank account instead of spreading it and buying new technology. I still believe it can continue to grow throughout those vectors while counting on a very solid foundation to generate a lot of cash flow, which are the wireless business. If you want to know more about Tellis, I just released a video on this channel a few weeks ago explaining you which metrics to follow and how it's going to go moving forward. But the fact that the company issued 2 dividend increases again this year and keep on its promise to deliver between 7 to 10% dividend growth through 2026 alive, I'm a big fan of Tellis at this point. Moving on to another of my favorite company, and I'm already telling you, the point here is to start your portfolio with a solid foundation. So if you've been sitting on the sideline, you may as well go for obvious picks, companies that are very strong and have proven their ability to outperform their peers. And this is one thing that National Bank is doing incredibly well. It is the most generous company in terms of dividend growth rate over the past 5 years, second behind TD over the past 10 years, and it shows the lowest payout ratio as well. So they have plenty of room to continue to be a leader as a dividend grower. They are performing well because, as you see, that the revenue and the earnings are going up. Over the past 12 months, earnings have remained stable due to higher provision for credit losses. Hopefully, we got some good news about interest rate, and then it's going to turn the tide around and it's going to go back into earnings growth performance next year. But in the meantime, it remains a very solid dividend payer. What I like most about National Bank and its diversification. So it is a small bank, more agile than most of the big banks for that reason. But the thing is, 40% of their business is classic activities around personal and commercial banking, and all the rest is actually going from wealth management, financial market, US and international business activities. So they're super well diversified, and they used to be a small Quebec bank. Well, now you can see that half of their business is coming from Quebec. The other half is outside of Canada, or is actually in Canada or outside of the Canada, with 19% of their business. So with such a great diversification, even if we have a mortgage crisis in Canada, well, 50%, a little bit more than 50% of their business is made outside of the classic banking and saving activities. The number 3 on my list, a recent acquisition for my own portfolio, Stella Jones, ticker SJ. As you can see, the dividend triangle is pretty solid here. So revenues going up, earnings going up, dividends going up, and now you're going to tell me, but Mike, I'm a bit reluctant in buying a stock that is trading close to its all-time high. I get that, but when you look at the PE ratio versus the past 5 years, when you look at its yield versus the past 5 years, you're still in a pretty solid position in terms of valuation. One thing I really like, and I'm getting very excited about Stella Jones, and the reason why I decided to pull the trigger, even if the stock price was close to an all-time high, and is the company has several growth vectors. So the business, I mean, it's not just selling lumber, but it's actually selling a lot of utility poles and railway ties. And when you're thinking about how government needs to invest in infrastructure, they need to expand their territory, they need to massively put a new infrastructure in place, well, utility poles and railway ties will be in high demand. So for that part of the business, it seems to be pretty solid. And the other thing that I really like about Stella Jones, and it's also able to grow by acquisition. So here you're looking at a company with a low yield, high growth perspective that has a great balance between organic growth and growth by acquisition. The last one on my list for this year, this one was added also in my portfolio in 23, Brookfield Corporation, ticker BN. Brookfield Corporation, definitely a complicated one. When you look at the dividend triangle, you may say, but Mike, that doesn't fit at all, because we see revenue growing, but earnings are not growing, and the dividend seems to have get caught, which is not what happened. And this is why I'm saying this one is more complex. It will require you more time to dig in, to read about financial statements and to wrap your head around it. So you might want to let it go and skip it. But this is also why I want to talk about Brookfield today. So for the earnings per share, the right metric for this type of business would be more FFO per share. And in terms of the dividend, actually it continues to increase. The thing is, at the end of 22, they spun off actually it used to be Brookfield Asset Management, and then they spun off that portion, which is an asset light manager. So that means that they only get the money from others. So pension plan, institutional investors, retail investors. They receive the money, they manage it, they invest it in infrastructures, funds, and other long-term assets, while Brookfield Corporation is the mother of all the other Brookfield. So this one is an asset-heavy alternative asset manager. So that means that on top of receiving money from others, they also invest their own capital in the business. So you can see here how the capital is being allocated. So you see that 85% billion is being inside asset management. So BAM, this one is really all the money coming from retail and institutional investors that are invested across multiple companies. They do have a reinsurance business, so they have insurance solution there with 8 billion. And the other big part is invested in Brookfield Infrastructure, Brookfield Renewable, Brookfield Business Partners, and a bunch of other companies where $45 billion are invested from their own Brookfield Corporation capital. So in general, 140 billion, generating 5 billion a year in cash flow all the time. So while there is a risk with the complexity and the opaqueness of their financial statement, it's hard to get your head around everything, and I get that. On the other side, it's really difficult to fake distributions, right? And all the Brookfield Infrastructure, Renewable, BAM, and also Brookfield Corporation has been able to increase their dividend year after year for more than a decade. So for that reason, it is also added to my portfolio. What I like the most about Brookfield Corporation is the fact that they invest for the very long term. So alternative assets means that they invest in companies and in projects that requires a lot of capital and that will still there for a long time. So we're not talking about equities there, but we're talking about massive project that requires patient capital. And as a dividend grower with a long-term mindset, it is exactly aligned with my goals. If you want to know more about how you can set up your portfolio, how you can tweak it, and what would be the most important investment themes of 2024, I will have a new webinar coming up next week on January 10th at 1 p.m. Eastern Time. You just have to click in the link description below. You put your name and your email address. You'll be registered for the live event. I answer all questions to live attendees, and I will also send you the replay. So if you're not able to make it on time, or if you can only watch a portion, or you cannot watch it at all, still registered for the free webinar, and I will send it to you, the replay, with the questions and the answers to your email address. All right, guys, tomorrow we're gonna talk about my 4 favorite stocks for 2024, and so make sure that you like this video, subscribe to the channel, and turn the notification on to not miss tomorrow's video, because it will be super interesting. All right, take good care, and until the meantime, don't forget to stay invested.